Hello and welcome to the IBSA series of podcasts on considering countries to where UK residents may wish to emigrate in light of the non-dom changes proposed by the Conservatives and the likely implementation of these rules under the new Labour government, which might include bringing foreign trust assets within inheritance tax and increasing capital gains tax rates to income tax levels. That's particularly aiming at fund managers. My name is Roy Saunders, founder and chairman of the IBSA, the International Business Structuring Association, which is a multidisciplinary global association of entrepreneurs and their professional advisors dedicated to sharing their expertise with each other within a great networking platform. Our current series of 15-minute podcasts will review beneficial tax regimes in Italy, Spain, Portugal, Malta, Cyprus, Switzerland, Singapore, Israel, and Dubai. Now, today I'm joined by tax specialist and accountant Geraldine Schembri, a long-term and valued member of the IBSA, who is a partner of EMCS in Malta, and David Borg, a chartered accountant and founder of ARQ Group, a professional services organization based in Malta. So welcome, Geraldine and David. Malta can join Cyprus, Italy, Spain, and Portugal, amongst some of the countries we're covering in our series of podcasts, offering great food, wonderful weather, and an excellent tax regime for incoming residents. We'll talk about that in a minute, but what's the criteria for individuals becoming tax resident in Malta?
Well, criteria to become tax resident, well, not really anything particular. What we are looking for is people who actually have and established Malta as their place of ordinary residence. And apart from, of course, meeting the regular criteria such as fit and proper. But apart from that, it's just a question of whether they want to go under one of the tax regimes that is available for people who want to establish themselves here or establish their residence. And there are regimes which cater for people who come from the EU and EEA and Switzerland, and for people who come from outside the European Union. So it all depends on, of course, the nationality, the domicile of the individual. It also depends on the particular circumstances of that individual, and also what they plan to do, whether they plan to continue generating overseas sourced income, whether they want to enter into business. All of these parameters need to be viewed at with a person, with an advisor who can then point them in the right direction.
Is there a set number of days, a minimum number of days that they have to reside in?
If you stay 183 days in Malta, you exceed those 183 days, you're tax resident in Malta. Okay, but if you intend to reside in Malta, then you become resident from the day that you intend to reside. We have the concept of ordinary residence. So if someone comes to Malta with the intention of some permanency, some continuity, and he will be caught up as an ordinary resident. So you can have a situation of someone who comes and he stays regularly for 3 years. In that case, he's ordinary resident. You can even have someone who doesn't spend 183 days. He's not here for a significant period within a year, but because he intends to stay in Malta, he intends to be ordinary resident in Malta, and he creates sufficient personal and economic ties to Malta, then he will be deemed to be ordinary resident.
So somebody coming for, say, let's say 30 days at a time regularly to Malta, he has a home in Malta, but he comes back and forth. Let's say he comes back to the UK. You know this yourself, Geraldine, that you can spend, let's say, up to 90 days in the UK. So they want to keep on coming back and forth, but basically they don't have to be there for 120 days or whatever. They can be it's the intention that's important.
Yeah, you need to see the assessment of the time, obviously, in terms of all the factors as well. So as David mentioned earlier, you need to look at specifics. We don't say a specific day, number of days. You need to see how much ties he's attached and what the particular circumstances are. So if you have an entrepreneur, for example, who comes to Malta and for business reasons has to travel extensively, and therefore he is not spending a significant amount of time in Malta, but he still has significant personal and economic ties to Malta, then yes, you can possibly have a situation that he's resident in Malta. He's ordinary resident in Malta. But then if you have someone who just comes for a bit and has no attachment, simply just rents a property and nothing else, that could be very difficult to justify as someone who has a sufficient ties.
Fine. So
It's also interesting at this stage, possibly, to mention, Roy. So the basis of taxation in Malta can either be on a worldwide basis, whereby if the person is resident and domiciled, he's taxed on all his income, whether it's remitted to Malta or not. Or else, if the person is resident or non-domiciled and non-domiciled, he would be taxed on income arising in Malta. He would be taxed on income arising overseas but remitted to Malta. And then he would not be taxed on capital gains arising overseas, even if those are remitted to Malta.
And also, if you look at inheritance tax, there's no inheritance tax in Malta. So,
Yeah.
so it is an interesting jurisdiction for estate planning, family office type structures, family trusts, foundations. So it's quite a versatile regime, which is, I suppose, borrows a lot from UK tax legislation.
well, that's a difference to the non-dom regime that we had. And also, of course, we had a limited period of time for non-doms.
Which doesn't exist in Malta.
Yes,
There's no
it's not
limitation.
in-
Obviously, unless the person's status changes and his domicile status changes. But there isn't a period of time.
Yeah. And so
So there-
far, we
Yes.
don't have deemed domicile rules
Correct.
which kick in, unlike the UK, where before it was 14 years or 15 years, and now it's reduced to 4. So that's also something which I think is quite valuable as well.
So David, there's no specific tax regime for incoming residents. It's a question of whether they're non-domiciled and can benefit from the remittance basis. Is that the only one?
No, not precisely. So there are specific regimes, but as Geraldine mentioned before, we look at residence and we look at domicile, and we also look at intention. So if a person intends to make Malta his center of vital interest, where he habitually returns to, even when he's traveling for business or for personal reasons, but he habitually returns back to Malta, that is a very strong indicator that the intention is to make Malta his center of vital interest, where most of his social and economic ties are established.
Where we have in Italy and Spain and Portugal, you have a limited period of time, like 15 years, 10 years, whatever, UK 4 years under the proposals here. You have no limitation of times, but so you don't need a special tax regime like you have in Italy, Spain, and Portugal for incoming residents. This is a standard thing for anybody who is non-domiciled of Malta.
If you're resident and non-domiciled, and if you're resident and domiciled, there are specific regimes which are enshrined in our Income Tax Act. But then there are also supplementary tax regimes which have been introduced, I would say, maybe the last 8, 9, 10 years ago, and which have continuously evolved. And these are primarily meant for people who wish to come to Malta either under a retirement program. There's the Malta Retirement Program, which taxes retirement income at 15%. And then there is the Global Residence Program, which is intended for people who come from outside the European Union, who wish to set up their residence in Malta and benefit from this tax regime. And then there is the Residence Program, which is attractive for people who come from the European Union.
I would say the difference here, David, is whereas if you come as an ordinary resident person, number one, you have to make sure that you can enter the country. So an EU person has freedom of movement, non-EU persons have certain restrictions. There are visa programs, but we will not enter into much detail there. But the difference is if you opt under the normal basis of taxation of residence and domicile, then you fall under the standard tax rates. So that goes from 0 to 35% progressive tax rate. Whereas if you enter under the programs, as David was saying, you're locked in at 15%. And therefore, there are minimum tax amounts that need to be paid for the different programs. But the income that you receive beyond that minimum tax amount is taxed at 15. So let's say someone has 120,000 income, which he wants remitted to Malta. Okay, and he can't plan around using capital. In that case, he would avoid being taxed at the rate of 35%, which would kick in on anything over 60,000, and he would be paying at 15%. So I think if you had to gross it up, that's 100,000. Anything over and above would be taxed simply at the rate of 15%.
And on any tranche above the 100,000, underlying tax relief provisions also kick in.
Correct.
So effectively on anything above 100,000, which is remitted to Malta under this program, would probably benefit from a lesser rate of tax than 15% because of the underlying relief.
Okay, so that's very interesting. So what restrictions are there for UK people to enter? Obviously, we're not part of the EU anymore, unfortunately. So is it difficult for UK wealthy individuals to migrate to Malta?
No, not difficult at all. Of course, you need to look at fit and proper. We need to be able to see, well, the authorities need to be able to vet the individual involved, make sure that they have no criminal record and they are not in any shape or form undesirable to the country, provided that they meet this fit and proper criteria, and they can also explain the source of their wealth. Then no, it's a fairly straightforward procedure.
Yeah, that's different for a lot of countries, so that's quite interesting. Okay, your government, have there been recent changes which could materialize, that could affect the way that taxes are imposed in Malta? I mean, for example, the 5% effective tax rate you have by imposing 35% on a company and then giving a refund of 30%. I've never thought that would be that approved by the EU, but it seems to have been. Is there likely to be a change in that? And what other changes do you anticipate over the next few years?
Well, we know that there is the introduction of the minimum tax directive. Malta has opted for a derogation, which is for a period of 6 years. There are current discussions, so we would expect the authorities to come with some tax proposal, but we have no clarity whether that would involve disbanding an existing structure or else putting in place certain provisions to meet the tax challenges going forward.
Okay, so but not for individuals. You haven't heard anything?
Not individuals.
No inheritance tax introductions or anything like that?
No, so far there's nothing which is in the public domain which gives one the impression that this is being considered.
Okay, well, I think that's all that I wanted to ask you on this podcast. It's very interesting. I'm very familiar with the concept of ordinary residence, which we had in the UK until 2013 when we introduced the statutory residence test. So that's very interesting, and it's a very interesting provisions that you have relating to non-domiciled individuals. So it remains for me to thank you, Geraldine, and thank you, David.
My pleasure, Roy.
Pleasure.
It's been really interesting, and thank you, everybody, for listening to this.